Hello, good morning, everybody. My name is Anu Oks, and I'm the Managing Director for Estonian Business Angels Network, and welcome here today for the 4NGELS training for investors. And today we're holding the second training for angel investors, and we're going to be focusing on metrics and valuations. And the second half of today's session is going to be a cross-border investors panel and looking into those market trends and the very fluctuating market that we're facing today, and that we're going to look the changes there. But what are we going to face today? Basically, there's 1.5 hours of the session, starting with small introduction from my side, then my dear colleague and friend from Superangel.VC, Marko Oolo, is going to going to take you through the metrics and valuations and the details of that. Then a small discussions and Q&A session, and we're here in Zoom today especially in order to give you voice and give you an opportunity to unmute yourself and ask away. And then this panel session on the economic situation and the cross-border angel investments, like how is this going on at the moment? I hope to have all the 4 countries that 4NGELS is working with to the panel. Unfortunately, this morning we lost Poland from the session, but we're going to still have Marko from Estonia, Petri, Lehmuskoski from Finland, and then Habinc from Slovenia. And I will be hosting this session as well. And then again, the questions and discussion from your side, and feel free to unmute or just leave a comment. I have a computer here that I can take your text comments or questions, but raise your hand, unmute yourself, and we can have your questions on live as well. And if you're here first time, feel free to go to or join our LinkedIn group, and it's called 4NGELS Investment Training Program. All the information about next trainings, ongoing topics are going to be posted there. And again, if you're here for the first time and you haven't heard too much about the 4NGELS program yet, then I will just run you through where are we at this moment of time and what is going to be expected in the future. So today, the second training, the third training will be on 4th of May, also online, also in the morning. And then we're going to look into the taxation and legal difficulties or challenges that cross-border investors might be facing. And then there's a pitch event that's going to look over top 10 startups from our syndicate of Latitude 59. The evaluation process is ongoing at the moment. Latitude 59 is going to be held on 24th to 26th of May, and Estban is going to put together a study trip specially meant for the 4NGELS program investors. So make sure to sign up, and we're going to send you a link and the program shortly. And I think these are the very last days to grab the Latitude 59 early bird tickets, and especially Estban is having a discount code for you guys as well. So it's L59 Invest X Estban. This code will be sent to you guys as well. Make sure to grab the early bird ticket as you can. And just a stop on the syndicate. Estban is putting out a syndicate to all, not to all, but to the most promising startup of the Latitude 59 conference, and you have an opportunity to join us with this. At the moment, we just stopped screening the 365 or something like that startups that apply to Latitude 59. And in near days, we're going to call out top 40. And then on the 17th of May, there's going to be top 10 pitching for you guys if you join the syndicate rally as well. And then the finals on the Latitude 59, and you have an opportunity to meet the team and everything when you join us for the study trip. But without further ado, let's get into the topic. Happy to have Marko here. You're sort of ready, right? Yes, Marko will be joining us here, and I will be leaving and giving the floor to Marko. Yes. Woohoo! Here's the clicker for you, and the technical team will be putting up the slides, and those are going to be there. Oh,
thank you.
Of course.
So, hi everybody, from my side as well. I'm Marko from Superangel, as I was introduced as well. I've been investing in Superangel, which is early stage venture fund, for 5.5 years now, and have been investing myself as angel investor as well. Plus, also, I worked actually in TransferWise before investing. So I was early employee in TransferWise, and then after close to 4 years, then I left TransferWise to invest into the similar companies, hopefully like TransferWise, getting to a unicorn status. And I was trusted with this topic today, so setting the KPIs and metrics for your startup. So just going over the basic startup metrics and KPIs. And secondly, I'll talk a little bit about negotiating valuations, which is a very interesting topic to all angel investors. And I think this will be structured in a way that the first bit is a little bit basic in a way, just because if you know investing as well, so for investing you kind of need secondary school mathematics, so you don't need anything really advanced. So the same goes with metrics and KPIs for startups. It doesn't need to be really advanced. It's just you have to get the simple things right, which give you the good levers in order to grow your company and understand what's going on. So let's get into the first bit. But yeah, so the background from my side, so there's obviously more things, but the main things which apply to startups and investing is through TransferWise and Superangel, plus my own holding companies where I invest from. In TransferWise, going back a slide, then I was responsible for, in the beginning, for growth analysis. So I was looking at all the growth metrics and then basically trying to figure out what the product team should build next. So that's one of the bases where I've been kind of doing work on metrics and KPIs, and also the product management bit. This is all about hitting your KPIs with the team. And secondly, in Superangel, helping the companies to do the same. Just probably like most of you haven't seen me around, or Estonians might have. So about Superangel, so our track record, usual track record of investors speaks on its own. So I think we have a quite track record which stands out. So we've with the team invested in three companies which turned unicorns. Also, there are plenty, like over 10 companies who are hopefully the next unicorns, and with the group with the investor with investors in Superangel and the partners, there's been over actually close to 20 exits in the last 5 to 10 years. So KPIs. KPI is a key performance indicator. I think this is quite known, but just to get our kind of thoughts aligned. So a KPI is a quantifiable measure that can be used to determine how well your company goals are being met. So the only thing KPIs help to do is help you measure if you're hitting your goals or not. And this is really important with startups, as everybody's on a timeline. And let's also look at the KPIs and metrics. I think these are the two terms which are basically kind of, some people think they're the same. I think there's a slight difference, and then we know what we're talking about. But what's the difference between metrics and KPIs? So KPI is a measurable value that shows how effective you are on achieving your goals. So basically, if you have set a proper KPI, then you can see if you're hitting your goals or not. What is a metric? Metric is just a specific, like basically a data points or statistics or basically numbers which help to track a specific business process. So either it's number of users, some simple metric. So basically it's not actually showing if you're hitting your goals or not. It's just tracking some kind of indicator. So every KPI is a metric, but not every metric is a KPI. And it's important because we can go into stats and numbers, and it might be a world of like you have a lot of different things going around, like you have tens and tens of KPIs or metrics, but you have to actually, in order to focus, you have to figure out what are the right ones. So let's just look at an example. So a bad example of a goal or a KPI and metric setting. So the goal is to go somewhere, which is a quite like bad goal on its own. So the KPI can be that are we there yet? And the metric is just something random. So basically this is just a bad example of a goal, but let's take a little bit a better example. So for example, just because of the pictures behind, it's the mountain climbing. So the goal is to be the quickest mountain climber in the history. So a good KPI could be meters of climb meters per hour. So you know that you have to go through a distance and you have to do it really quickly because you want to be the quickest mountain climber. So you have to measure the meters you go in some time period. And the metrics behind that, there's a different statistics you can measure, which are not KPIs on their own, can be just kilometers traveled, just meters climbed, time spent. And when you look at all of those individually, it doesn't say if you're hitting your goal, but if you form a KPI from it, like meters climbed per hour, that's a little bit better. So the same goes with startups. And I'll give you a couple of examples as well on what metrics and KPI startups should look at. So just going over, it's very actually a lot of detail is behind the red text. So KPIs help you to know if you hit your goals. Secondly, understand the drivers and root causes of outcomes. So if something happens, you have to be able to understand what did I actually do in the company in order to get that outcome. Thirdly, it encourages data-driven decision making. So decisions should come from a data-driven perspective in a startup. So you don't just randomly, like one customer said that do this, and the whole team basically goes and does something for 2 months, but actually there was only one person interested in that change. So KPIs and data helps you to do data-driven decisions. Fourthly, avoid arguments, and this is something I've come across in different teams as well. So everybody has their anecdotally examples, or basically you've gone through something and you think this is the right thing to do then, or you have you haven't looked at the whole spectrum of the market or what the clients want, and you just go with your own opinion to the discussion, full of emotions, and then whoever has the strongest voice wins. But data actually helps to avoid those arguments and do data-driven decisions. Also, KPIs help to encourage accountability and autonomy. So when there are right KPIs set, then people actually know what to aim for, what to do in everyday work, and you don't need to micromanage them. There can be more autonomy in the startup and more accountability as well, because everybody wants to hit their own KPIs and they can analyze that as well. And lastly, KPIs help to boost the morale of the team. So if you have done something or the team is pushing for something for months and months, and you are seeing this materialize in the graphs, or you're getting more users, you're hitting your goals, this helps to, it's a huge boost to the morale of the team. So this is something I've put together a little bit myself. So I think this is not, maybe I haven't seen this widely spread, but some of the things are really, really common. But basically a KPI package for your company. So the first two are really common, and the last one I put there extra myself because I think it's really important and has been more important in the last few years. So firstly, if you think of company KPIs, then I think three groups are necessary. So business KPIs. So business KPIs are the KPIs which help you understand how the business is doing. So basically, whatever your business is as a startup, then these metrics basically understand if you're getting there or not. So the financial KPIs is a little bit like a hygiene factor. So they help to manage resources, so you know that you don't run out of money. Basically, that you're sustainable, or when you get to sustainability, manage your runway. So these are all hygiene factors, but they're not business KPIs in a way that it doesn't like basically the number of users and the revenues you get is a little bit more tied to your company goals. And lastly, the mission KPIs, which is a very interesting bit, is the KPIs which help you understand if you are on the right path. And we don't like usually want to do anything, just doing things for the sake of doing. We want to have impact in the world, do something meaningful, and the startup as well. We're changing the world, so you always want to have some kind of KPIs which kind of help you understand if you're hitting your bigger mission, and that helps the team to be aligned as well. But let's look at all the KPIs, all the different packages more thoroughly as well. So let's take the business KPIs first, basically these are the like a selection of the main ones, and the startup doesn't have to look at all of them all together. You can pick the ones that kind of you can use yourself, but first one, really obvious, revenue. So as a startup looking at recurring revenue, either it's monthly recurring revenue or annual recurring revenue. Secondly, a lot of the times there are users or clients. So basically tracking just the number of users, but also you can check the monthly active users or monthly new users. And this is a little bit tied to the growth of the business as well, which is a third KPI. So the third KPI can be growth. So how much is the monthly compounded growth rate for a startup? And a lot of investors ask, like, how quickly are you growing month on month? So this is the number you should kind of figure out to put in your pitch deck. So 10% monthly, or you can do it annually as well. So going forward, churn. So just understanding how many customers are churning in some certain period. If it's a month or a quarter or a year. Next, retention, which is a little bit tied to churn, but basically how are you retaining your customers. So acquisition and the value are the last two ones. So everybody has heard of customer acquisition cost and the lifetime value. So these are really important things if you're basically in any company, but you want to understand how much money you're spending in order to acquire new customers. And secondly, if those customers are actually bringing that money back, is it a good investment to get those customers? So these are the example of business KPIs for majority of startups. Then secondly, let's look at the financial KPIs bucket, which are the hygiene factor KPIs. So again, there's revenue there because this is the top line. This is the money that's coming in. Secondly, having a really good understanding on the expenses, and this consists of a lot of different things. So it's COGS there. What are you spending in order to offer the service or a product? And the overall the other expenses, basically overhead, how much are you spending on marketing activities, on the office, etc., etc. So basically, you have to understand how much you're earning on revenue side, how much you're spending, and the next one is cash balance. Always understanding how much money is there in the bank, because this helps you calculate the runway of the company. And also there's burn, which is a very hot topic in the last year, but the burn rate of a company. So essentially, looking at the cash flows, how much money is leaving your accounts every month. So how much are you actually burning the investors' money in order to build out your product. And then let's go to the last one, the mission KPI package, which is, I think, very interesting because as an investor and myself as well, if I invest, I always look at something else than just money. So basically, you want this company to have impact in the world. One of my missions and our missions is firstly companies to build a sustainable future, and then secondly, companies building a world that my kids want to live in. So this is a little bit tied to the mission KPIs, and I think when a company presents or has a good understanding on their mission, it's a very strong argument for the investors as well, because investors want to create change. They basically finance the change. When a company understands their mission KPIs and can actually measure them, express them, it's a very strong argument. But let's look at some of the main ones, and it usually boils down to these 6, which you can choose from. Firstly, the cause. So basically, so you want to and then this comes with the green wave as well. So for example, the X tons of carbon emissions you want to avoid or capture from the atmosphere. So this is something you can measure. So on the side, your company has to earn money, but on the same time, your product or whatever you offer to the clients helps to reduce emissions as well. So in your pitch deck, you can put in that we're earning this much revenue, but next to that is with every dollar we make or every euro we make, we actually reduce emissions as well. And these are like a packaged deal kind of a way, but I think the money, counting money doesn't reflect the mission on its own, so there has to be a mission KPI next to it. But the mission can be something else than a cause, like reducing carbon from the atmosphere, but it could also be helping out people, so saving money for people. Basically, my own example from TransferWise, our one of the mission KPIs has been was and is still today as well, how much euros we've saved our customers throughout the whole lifetime of TransferWise. So I think it's in billions now. So if customers would still do their conversions and money transfers through the banks, they would have, like throughout the lifetime of TransferWise, they would have paid the bankers billions and billions of euros more. So TransferWise's core mission is helping to save more money, so people can use that money for good cause. So this could be something. So you have your revenues, and secondly, you measure the money saved for customers. So do different metrics, but basically they have a correlation as well. So the third mission pillar could be time saved. So your product is saving customers time. So you can stack up. It's a compounded metric. So you can throughout the lifetime always compound how much time you've saved for customers. In general, you can also calculate how much time you're saving customers every month or every quarter. Next one, convenience. So some startups, some products are basically built to offer a more convenient product or a solution to customers. And something what everybody has heard of is doing something which is 10 times more convenient than the old way of doing it. So you can track. It's a quality metric, so you can do customer surveys in order to understand how much more convenient they find this to be. Not the last one, but one before the last one, coverage. So maybe you're covering more countries than the competitors. So your service is available in 100 countries rather than other services available only in 2 countries. And lastly, trust. This is a very subjective metric, but do I feel safe using this service, essentially? So as the time is running and I want to cover the other topic as well, then then, and if you have questions about the KPIs metrics, then let me know afterwards. But let's go through the valuation negotiations as well. I think it's really interesting topics. So this picture represents how investors how they figure out how much the company is worth. So that's a really sophisticated method. You put your finger in the water, and you put it. Then after you hold it up in the air, and then you kind of understand where the wind is blowing from. So this is actually, it's kind of true, but there's a lot of art and science behind it. In a way that this is called gut feeling, but gut feeling is actually formed from your own experience from the past and how what kind of experiences you might have. So these are some of the ways actually how to determine a value of a startup. So let's go through them quickly. So first is a multiple. So a lot of sectors have different multiples on either revenues or actually, like in the stock market, there's on earnings, on profits. So basically the PE ratio, PS ratios are in the stock market, but same goes with larger startups. So if you're e-commerce sector, you might have a multiple on your sales. If you're in a SaaS sector, you have a different multiple, like 10 times your sales could be your value, etc. So these are these multiples, and some companies or some investors use them in order to determine the value. But it happens a little bit more in the later stage, not in the very early stage. Second, it's the metric-based value determination, or determining the value based on metrics. So you can determine the value of a company based on the revenues. So if you have a certain amount of revenue coming in, then this is usually equal to some kind of value. And I'll show an example later. It could be growth. So if you're growing 100% every year, and you've done this the last 3-4 years, this could give you a certain valuation. The amount of users. So in some cases, the users are more important than the revenues. And in those sectors, based on if somebody wants to buy those users from a company, they're willing to pay some price for the company. And then lastly, in deep tech, there's a unique technology or patented technology as well, which is valuable and can create a certain value. The third one, runway-based calculations. So for example, the company needs 18 to 24 months of runway and is willing to give away 15 to 20% of the company in order to get enough cash in order to cover that runway. So this is a way to do a backwards calculation and finding out how much a company is worth. The fourth one is the market. So essentially, it's either feedback from the market, feedback from investors. So a lot of investors say that this company should be worth this much. And when 1,000 investors put out their opinion, the average might be the market average, what the investors are willing to pay for the company. But also there's comparison method. So when 4 similar startups have raised money in a seed round with this valuation, then this might be the similar valuation what you have, and you can basically adjust this based on the specifics your company has. Either like I don't know, you have a better team, you have more traction, etc. But you can do a comparison method. And the last two are really interesting. So one of them is your own way of determining the value. So if you're a founder, you just go with your own price. You just figure out that, hey, I don't know, it's 10 million, take it or leave it, and there's it's a little bit tied to your confidence and your time in the game. So if you build startups before, you might be able to pull this off. If you're a first-time founder, going there, just putting a price in the market, it might not be accepted. And the last one is leverage, and this comes a little bit more from the investor side. So sometimes the price of a company is determined just how much the investors is willing to pay for the company. You might have a really good runway, like a long runway ahead of you. You have really good numbers, you have a lot of revenue, but if no one is willing to pay a certain price, which used to be like some kind of a logical number, then that's the new market price. And sometimes investors have leverage. When you have a short runway, they have more leverage, etc. So these are the ways of kind of finding out the valuation. So let's look at a couple of examples. So a valuation based on runway. This is something which is done maybe the most often, or one of the most often ways how to determine the value. So let's take a really, like not the pre-seed example, but a company is burning 100K a month, and they're aiming to raise the next round, and then they want 24 months of runway in order to get to the next phase of company. So in essence, they need, if you do a quick calculation, they need 2.4 million euros to raise. And with every equity round or a considerable round, a company should be willing to give away maybe 10 to 20%, but let's say the times are tough, and the company has to give away 15 to 20% of the company. And when you do a backwards calculation, or reverse calculation, then you can get that if you need 2.4 million euros and you're giving away 20% of your company, then the valuation is 12 million. If you're giving away 15% for 2.4 million, then your company valuation is 16 million. So this is something really easy you can do. It's based on how much money you need for the future. But the question here, what's missing is does this pricing make sense in terms of the competition and the company results? So you might be burning 100K, but if your revenues are zero as well, then it doesn't maybe match with, like, you're just burning too much money and you don't have any results. So this method has to be based on some sanity check as well. Is this like an average thing on the market right now? And does your company actually have results enough to compare with the 12 to 16 million valuation? So this is the kind of a bucket of thought which to go through. Understand your leverage in negotiations. And this is a very simple graph from Y Combinator. So on the axis, on the vertical axis, there's the leverage of negotiations up there. There's a lot of leverage, and in the bottom there's none leverage at all. And on the horizontal axis, there's the startup's runway. And basically, and the black line represents the founder's leverage, and the red line is the investor's leverage. So when a company founder and as a company you have a long runway ahead of you, then you have more leverage to play around with the valuations and then the fundraising. And why that is because you have more months in order to create better results. And based on the momentum, you can start raising now, or you can wait 1 or 2 months and raise then. But basically, you're not in a need to get the money right now, or run out of money. But it's kind of opposite for investors. Investor leverage is a lot lower when a company is not in a high need of money. But when a company is running out of their runway and you have a couple of months left and you have nothing else to do, then an investor can negotiate and use their leverage to negotiate a better price. Quite understandable, I think. And whenever everybody's been in those kind of situations when you invest. So I recommend founders more to look at this actually, to understand that they can't start raising money when they only have 3 months left of runway. So how to determine the value again, and how much to raise? So this is just a matrix of different things: a stage of a company, the ARR, which is a widely known metric or a KPI, but in Estonia, for example, we look at more monthly recurring revenue, but it's kind of the same. You can do a times 12 on the monthly recurring revenue and you get ARR. Then the third column is how much money you're raising, and the last is valuation. And these are like basically adjusted new numbers based on a little bit of a gut feeling. But let's say a new competitive Series A would need like 3 million ARR, and then in that stage you kind of need to raise 3 to 5 million euros. And when you're willing to give away 10 to 20% of the company, it usually translates to 25 to 50 million valuation. And when you come to earlier stages, then for example, seed stage, you're doing maybe 15 to 16,000 MRR, 200K ARR, and in this stage you need to raise 800K in order to last for the next 18 months. And your valuation, when you're giving away 10 to 20%, is between 4 to 8 million euros. So just like a startup founder and an investor as well has to understand a little bit of these kind of things. Obviously, there's a lot of playing room there as well. So what actually a little bit of example what I do as well in order when I go into valuation, figuring out the valuation, so assessing the potential of a company. And the good question is, what needs to happen with the company for this company to return my whole startup portfolio? Or as a fund, we think of the same way. What should happen for this company to actually return the whole fund? And I don't know, this is a screenshot moment right now if you want to look at this closer, but basically what is here in the up top of the table, there's you put in your ticket size, the proposed or the valuation you're thinking of. It calculates the ownership you'll get. There's obviously the numbers from the company as well, how much shares there are, what's the subscription price of a share, and then what's the round size. So all the light yellow background fields are something you can change. But basically, the first thing is helping you how much stake you get in a company. And then the next kind of calculation is taking into account the dilutions in the next rounds and the lifetime of a company. So, and it basically calculates so what needs to happen with the company to bring your own whole startup portfolio back. And in this example, for example, we know that if we invest 400,000 euros in this round as a fund, we'll get 7.5% of equity ownership in the company. And with the next 6 rounds, we are diluted down to 2.5%. So basically 20% dilution per round, 6 rounds, and basically our stake in a company is 2.5% opposed to the 7.5 it was before. And if we want this 2.5% to bring back the whole fund, the company has to be valued 1.2 billion, so a unicorn essentially. So this is something I kind of do on the background, just figuring out does this company have potential to grow that big? And I want every company we invest in to have that potential to return the whole startup portfolio, because this is how the risk is managed. And below there's just the example of the ARRs and based on multiples, the potential expected valuations in different rounds over the years. And I want the company to understand this track. So they have to do 20 million ARR, to have 140 million valuation, etc. So we can ask questions around that as well. But I think last question that I had here is to think of when you're kind of assessing the valuation is, how is the round coming together? Is there a lead investor in place? So are you, if there is a lead investor in place, are you happy with the validated price of that lead investor? Or is the round already subscribed? Because if there is a lead investor in place, you can't negotiate valuations. But if there's no lead investor in place, is there enough interest to fill the whole round? So some of the questions you might ask before. And lastly, a good meme. It's a great pitch, amazing product, and for that reason, I'm out. Thank you. My time is up.
All right, hands together, and I will bring you a glass of water as well. Thank you, Marko.
Thank you. My award.
Your award, yes, your present. Let's see if there's some questions coming from the Zoom. So now all the participants, there's 38 altogether.
Oh,
so
okay.
quite a nice number. So if there's some questions for Marko, then type it in the Zoom or just raise a hand, and we will get your question. But actually, just to start off with my questions, going into the KPIs and metrics.
Well, we have the whole notebook full of questions.
Yes, you can see 10 pages for questions. So how can the investor, especially looking on the angel side, so how can the investors help or even force the startups to set those KPIs and metrics that make sense? Is it rather on the help side or on the force side?
So there's a little bit of leverage in the beginning. So for example, when you go in with a ticket, you might set a small term that we want to track these metrics or these KPIs. So you send just a small list, like 5 KPIs that you always have to send back to me every month that I want to track these. And these can be really the business KPIs, for example, revenues, users, I don't know, some hygiene numbers like runway, cash in the bank. And I think that covers the gist of it. But I think it's not enough for the company to basically it's not enough for the founder to build a company. So these are not the KPIs that you actually can kind of use in order to get to your goals. So what I've done is just on goodwill. I don't put this into the term sheet, but I set up just onboarding or kickoff meeting after the round is closed. Let's sit down. Let's look at your KPIs, your numbers, and I've with close to like 6 to 10 companies around that. I've actually gone through the process. We've figured out, done a whole session on what is their business like, what should be the business KPIs, so what are the hygiene KPIs and what are the mission KPIs, and built out a structure, a dashboard, and some companies are like after 5 years are still using it just because it's a good way to understand if your company is doing well and be prepared for the next money raise as well. Yep. So it comes a little bit with experience as well. So when as an investor, when you have understanding on KPIs yourself, you can go to the company and offer this. And I think I haven't seen anybody like refusing to get this help.
Yeah. A question from Zoom: what is a normal runway for a startup? Has it changed in a current environment?
Yeah, it's changed quite a lot actually, in my opinion. So I think if we take 2021 or 2019, these couple of years are just outliers a little bit. So it didn't really matter how much runway is the company getting after the round. So it used to be like maybe 12 to 18 months is good enough because you know that in the next 12 months you can raise again. But now the money is really scarce on the market, or money is actually not scarce, but people are afraid. And that's why every round that comes together kind of has a prerequisite of getting 24 months of runway. So this means the company has to raise a lot of more money. And for example, let's say the company needs 1 million to get 2 years of runway. But if the company only is capable of raising like 400K, usually the investment's not going to go through because it's not reasonable to throw in 400K for the next 6 months and the company is in the same situation again. So I think the expectation on runway has changed a lot. And we see it as well. We kind of want the companies to have 2 years of time to build out the company. They're getting to their goals. And we know that if they only have 12 months, they're going to be in a really difficult position in the next 6 to 9 months because you have to start raising 6 months before. So just close a round and in 6 months raise again. It's like really hard.
So are you now focusing more on cost saving as well? Like one part was like how do you actually spend the money, for what do you spend, like how quick do you grow? But do you now look more on the cost side as well? Like on what do you spend?
In 2022 beginning, kind of old metric was reintroduced to the scene, which is burn multiple, and it's spread quite a lot. But what it means is like basically next to how much the company is burning every month, you look at the growth of the company, and there's a ratio. So if you're growing really well, you can burn a little bit more, but if you're not growing at all, you can't burn as well. So there's a kind of healthy number. It's like a combined metric. So if it's under 2, you're doing quite well. If it's over 2, you're burning too much. So I encourage everybody to look up this metric. But if you put this to a company dashboard as well, you kind of can ensure that everything is in balance. So if they're growing really fast, then they're allowed to burn a little bit more. But if they're not growing at all, they have to cut down the burn, which essentially means cutting your expenses. But I don't know, when a company is growing 200% a year, 300% a year, I think like they're getting revenues, right? So the future revenues are higher, so essentially they can cover that burn
more. Yeah. So actually, there's a really long question from Zoom from Trino. So Trino, I would really be happy if you could unmute yourself and ask this question right away, if you're willing for that. Yes, Trino is there. I wonder if we can see her as well.
Hi.
Hi, Trino. Long question. You can ask it.
Do you hear me?
Yes.
Yes.
I like the meme that you ended with, and it was like, great pitch, great product, I'm out, right? But actually, we always say like great pitch, great product, and give actually quite a lot of hope to all the companies, because it's uncomfortable to say no straight away, right, and in your face. But these days I have had different times when, you know, if you give too much hope, startups really base their next decisions and also the next maybe talks to investors on that, meaning that, you know, if Marko is saying that, you know, great pitch, let's talk later, then they put you in the pipeline of, you know, potential investor, which is okay, of course. But if you're actually not intending to, then maybe you should just say it out. It's like sort of ethics of investors as well that I say that see sometimes. You know, we don't consider the effect of our words, right? If we talk to investors, to startups.
Yeah.
Did you understand what I referred to?
So I think so it's a very difficult actually thing of saying no and giving like hope in a way, because there's one hard thing in there. So when there's something like, let's say the company doesn't like fit your funds or your investors' mandate or your focus. I don't know, I only invest in software companies, and if it's hardware, I say, sorry, I don't invest in hardware. It's quite easy to answer like no. Or you're too early, you don't have enough traction. I like to see usually like, I don't know, more traction than, and we can talk again when you have that traction. I think that's giving up hope, but reasonable hope, because the company is not out of your specter. But if you don't like the founding team and you don't believe in the team, it's really difficult to say that, hey, I think you're not a good team, and you never say that out basically. And I think that's where the giving up false hope comes from, because you don't have any other reason. Like I think like everything else is kind of okay, or everything else is based on the team. So if the team is bad, nothing else actually like matters too much. So, and you don't want to say that out because it's just a rude thing. You want them to discover that themselves somewhere
they're a lousy team.
Yeah.
Oh, it's us. It's not you guys.
Yeah.
It's us. Oh, damn.
And I think you don't want to burn bridges as well. That everybody's like founders are going around the ecosystem and saying that, hey, this guy is a douchebag, just like insulted us in an email or something. And this is where the problem comes from. And you give out that, hey, yeah, not yet. I don't know, some hazy no. And then the company is kind of expecting or kind of coming back to you and saying that, okay, but we've now got 10K more revenues. Are we good enough? Are we there yet?
Yep.
And I think this is the problem actually.
And then the startups are coming to Estban, for example, and saying like, yes, all those VCs are asking for 10K like revenue, but actually the reason that VCs are putting questions mark are the teams. Joe, basically we need to move on with the panel, but before that, just a really short, maybe you have some suggestions on tools for the keeping track of the metrics for the startups, or I don't know, is there platform or a tool that you use or the startups that you invest in use on a daily basis?
I found a really good tool which is called like an Excel spreadsheet.
Oh,
So basically. So obviously there are the tools of like Investory.io and Rundit and all of those things. I think these are kind of fine, but all these things are actually happening before that if you put them on a platform. So that platform is not robust enough to play around with all the metrics and data. So a company has a spreadsheet on their own anyway, and to build out kind of like new numbers come in automatically, or you have to put them in month on month or whatever, and building the graphs on top of that is really easy there. And if you want to push those for investor relations to some kind of platforms, I think that's fine. But without a spreadsheet or something to do the finances things in a startup is quite difficult, I believe, and you don't have enough like leverage to understand your situation. I think, I've seen like all the good examples still use spreadsheets, and then you can't move around from there. But other than that, I think no platform is going to solve the KPI setting issue.
Yep.
So you have to set the KPIs yourself, think what are the good things to look at, and then you will find a way to kind of present them.
Yeah. I think I agree.
Sorry for the Excel answer.
That's fine. Maybe someday a startup comes and solves this. But still, if Excel works, then it works. But let's have now Petri Lehmuskoski and Rock Habinc also joining us. I see Rock over there. Let's see if we can find Petri as well. Hi there. So maybe hello. Maybe our technical side could just pin out the important ones. Yes, there you are. Trino, maybe you're also now one of the panelists. I can see you like over there. That was a joke. All good. Petri, a really seasoned angel investor from Finland, also a member of Fiban, also a member of Estban. And I found that you founded Gorilla Capital already in 2012. Is that true?
Yes. I started the angel investing in 2008, 2007, and the lessons learned was that we put together Gorilla Capital. It was an angel fund. We were 17 angels, pulled our money together, and really that was 2012. And 2015 we did our second fund.
Yep. And now you're on your third, isn't it?
Yes.
All right, and Rock from Slovenia. What about your short history of angel investing and being on this market?
Being a venture investor since 2010 with a smallish VC fund, and since 2016 also active as an angel investor.
Yeah, pleasure to have you all here. So actually the idea of the whole panel was to look into the market situation at the moment and how does this affect the angel and VC scene. So you already started with the getting the next rounds and runways to be set on not 18 months but 24. So what have been the main changes for you guys all? Let's just have this openly. Whoever has a thought, then just jump in. I don't have like specific questions for each of you. So what are the main changes that you have witnessed, seen? Is this the valuation? Is this the runway? Is this, I don't know, LP is not investing in VCs anymore, and then coming the changes from there? Marko, maybe you can start.
Yeah, okay. So I'll give a couple of nuggets and then I'll give the word to others because I think some of the things are quite general. From investor side, starting from smaller, actually going to bigger as well. I think angel investor money has dried up a little bit because some of the angel investors' own portfolio is in the stock markets as well. If that's hit, then you're kind of thinking of if you have enough money on the side and if you want to still keep investing in the really risky asset class. So I think that has dried up a little bit. The appetite of doing like just throwing out 10 or 20K tickets here and there is less out there. So I see that. From the other side, we raised the fund as well. So getting LPs to a fund is obviously a little bit more difficult. Some of the fund of funds don't have mandates anymore. Some of the private investors are limiting their allocations to different funds. So I think it's tried up a little bit more as a preventive measure. Like everybody's like, maybe the times are like not going back to like there's not going to be the good times again in the future, and then just holding back the decisions a little bit. And I think that's affecting it. I think we haven't seen anything really materialize. Yep. I think not huge bankruptcies or anything has happened with a couple of examples, but these are really edge cases on crypto and some other stuff. So this is a perspective from the investor side, the money drying up. So I'll give a word to others to fill in some other gaps.
Yep, and this is very eastern part of Europe in Estonia that we are. What about the quite middle of Europe, Slovenia? What do you see?
I think there's a lot of doom and gloom in the financial markets, but the real economy is still doing quite well, quite strongly. I mean, we're not seeing recession, although there's been talked about the recession for a long time. So the unemployment is still extremely low. So actually, the general industry and the general economy is doing well. Investors are a little bit shy these days. Also, private corporate investments are a little bit low. They're afraid whether they're going to be growing as quickly as possible. But I think the doom and gloom scenarios are still over. You know, there's too many of them, and the economy is actually doing really well. So these may be actually good times for investors, for angel investing. You can get in at some lower valuations, and the founders have come down with their valuation expectations, which were out of any sync a year and a half ago. And the numbers have come more to some real and reasonable numbers compared to some multiples that we've seen in, I'd say, a year and a half ago.
Yep. Petri, what's your thoughts on that? Are the valuations coming actually down?
Let's first talk about the available money. Habinc came out with the Finnish Business Angel Network came out with 2022 statistics about 2 weeks ago. And if I recall correctly, the angel money in Finland went down about 40% compared to 21. That yes, there is a shortage of available funds on all levels, angels, VCs, or maybe not the shortage of funds, but there's more consideration giving on the where to invest in. Your question about valuations, we haven't actually seen any in our investment thesis, any change in the valuations. Maybe because we invest in camels, and they always have been, when we invest in quite low value. And looking on camel valuations in Finland, Sweden, Denmark, or Estonia, where we have invested in, really the valuations are quite equal on the stage we invest in. But that's an camel investment thesis we are following. And then, of course, there's a huge difference on when we are going for unicorn thesis. And there, the valuations have definitely come down.
Indeed. So do you see the Estonian startups valuations moving or easier to negotiate?
Yeah, I think there's something has happened. Obviously, the sample size is quite low because the number of funded startups is quite low as well. So it might be just 1 or 2 examples. And I think all the investors, like nobody has invested in 20 companies in the last 6 months. So I think it's rather been like a couple of companies, and then that's too small of a sample size to have your own opinion on. But I think, yeah, secondly, from the startup perspective as well, like raising money. So I think the filter is a lot thicker. So basically a lot less actually get funded, just because a couple of things. Expectation of better results from startups is something investors kind of want to see higher revenue numbers, more confidence. Secondly, the runway situation. So you don't want to throw in like 100, 200K in a hole, basically, that you don't know, you're not certain that the next funding is going to come in. So we see that in seed stage, companies are getting funded who can actually attract like 1 million or more. If you only raise like less than that, it's usually like a bridge round that's from existing investors helping out to get a longer runway, but a new investor coming in to an equity round, a priced round, it's usually, I've seen that the expected amount of money is higher. And that's a little bit tied to the employment as well. So one person to a company roughly costs 100,000 per year. It could be a little bit less in some areas, but if you put some overhead on top of it, usually one person extra is 100,000 per year. So if you want to take on like 2 people for 2 years, like 24 months of runway, it's also already like 400K. Then you want to have some other stuff, some other money on the side to build, like develop your product, whatever. So that's already like a 600,000 to 800,000 rounds.
Yeah. So what is the winning strategy to go then for angel investors? So there's, I don't know, 40 angel investors listening at the moment. So invest now. Some say invest now is the best time to invest. Some say hold back. Let's see where the market is going. So what's your take? What's your take on that? Maybe Rock.
I think good companies are the same in good times and in bad times. So if you have a good team, if you find a good team, you find a good company that you're willing to support, you'll be able to negotiate differently with them. Or if you don't want to come across as a shark, you can try to negotiate something around valuations in the future, something like that. But if there's a good team with a good idea, they'll be successful no matter the times. And if it's a bad team, the times can be brilliant, but nothing will help them. So I'm not changing my strategy at all. I still look for similar signs of value as I have before, and will do so going forward.
So Petri, what about you? Of course, you're now managing a fund, but if you would think back on your angel investing times, if
you look statistics-wise, this is the best time to invest in early startups. It is the prices, valuations are reasonable. There is like all the, and you're looking at exit markets 5 to 10 years in future, and then it's if you think because. This is a long time play. We do exits in 5 years investment period on our thesis. If you go for bigger exits, it's really fast up to 10 years. And then the markets will be quite different. And if you try to get later on the good startups, it will be extremely expensive if you can get in. There is good startups always are able to raise capital from the existing investors. Bad ones aren't.
That's a good theory or strategy. Invest into the good startups.
Yeah, well, I think like when as an angel investor you go with 10K tickets or I don't know, maybe a little bit more, you have a bias of maybe not. If your background isn't like supporting, if you only have money, you're really hard to get into the good startups. So they're not expecting a cap table full of 10K euro investors. So a really good ones get the money without pitching in conferences, etc. They just have a good network. And the average ones usually like hustle around, and the bad ones just don't get funded. So I think it's a little bit difficult, and that's why I have a recommendation as well, which would work right now really well, because I agree you should be investing throughout the years if you want to deploy, or you want to deploy money and then get 40 companies in your portfolio. That's going to happen over 2 to 4 years. So you have to constantly be doing it. If you keep like if you don't invest 1.5 years, it's a big gap in the whole portfolio model. But I recommend, as everybody here has a fund as well, then angel investors just make a relationship to, or just get to know the fund managers, the partners, and say that, hey, I'm still investing. I usually do like X euro tickets to companies, and I'm really eager to invest together with you. So whenever you have a company that you're doing a lead investor, you're being a lead investor on, and everybody's, it is sometimes like difficult to get the rounds together. So when there's eager investors who have good backgrounds willing to help, you're always gonna invite them on. Or we don't have, like in Superangel, we don't have a mentality that we have to be the only investor in a seed round. So I think valuable angels are always welcome because they help with their different specific expertise. So I recommend create relationships with partners or anybody in the fund. Say that I'm doing like X amount of euro tickets. Happy to invest together with you. Look at everything what you do, and then if you have 4 funds that you follow. They do, I don't know, 1 deal per quarter, like really like low cadence, but then you have a good access to 4 deals a quarter that you can invest in. And also you're sure that you're not the only 10K that's going into the company, but there's like a 500K plus going from the fund as well.
Yeah, so good idea. And I think the same applies for moving along business angel networks as well, just following the syndicates and the deals that go through there, that you're not alone in investing alone in this hectic market situation. So there's always winners and losers in every crisis. So in your opinion, who are the winners of this economic situation, energy situation? There's a war going on. So just your takeaway, who's gonna be the winner on sector-wise?
Let's give
them. Rock, what do you think?
My crystal ball is kind of foggy. It doesn't really show. If you want to pick the winners, you need to know what's going to be sexy in 5 to 10 years when you're going to be doing the exits. So a wise investor once told to me, always invest into sexy things that you expect will be easy to sell in the future, sometime in the future, or is coming today, and you expect that to flourish in 5 years or 10 years time. So that's where to look at things that are popular today and you expect to be popular in the future. I mean, certainly we lack workers everywhere. So anything about digitalization, automation, those things, increases in productivity, these are the winners, I'm certain, because the economy is going to grow. We don't have enough workers in Europe everywhere. So anything that helps increase productivity per employee is a good bet.
Petri, what do you think? Who's going to be winning the game?
Because we are an industry agnostic investor. Really, we don't bet on the winners. We bet basically the guys who build a sustainable business, and that's easy to find continuously. It's a little bit based on our camel theme investing, is that really we don't hunt the unicorns.
But you have to take out the losers. So who are you definitely not looking at?
The ones who are gambling. The ones who are gambling and think that they know something what's going to be in 5 years' time or 10 years' time. There was a good question on the chat. Actually, I don't remember who asked that. What the angel investors should do, small tickets, number of companies, or larger tickets on more selected companies. That's how I started. I thought that I can do bigger tickets on selected companies. Doesn't work on the early stage. And our recommendation would be that do more smaller tickets in larger number of companies. If you do picking, basically trying to hunt the winners, you need to have a really deep pockets, because the follow-up rounds can wipe you out also. You need to be able to participate. And if you do bigger tickets, it's bigger rounds what you have to invest in.
Yeah, makes sense. So who are the winners, Marko?
Yeah, I think something which I thought as well was the who are who actually can stay there to like have a chance to win the game and don't blow up in the middle. So being sustainable in a little bit, to have levers that when there's tougher times you can still maintain your team, still grow maybe a little bit slower, and when there's more capital available and you know where to invest that, you'll put step on the gas as well. So this is one of the things, but I think kind of goes to the value investing, or basically understanding what problem is the company solving, are the founders solving? Do they have a background in that field, or are they just like really good like eager learners? And they can figure it out quite quickly, because they have to go through mistakes really quickly. If you're not the quick learner, then you're going to spend a lot of time and money. But yeah, I think this in any sector, it comes down to that. So I've looked at the green sector, or the carbon market, for the last like 3 years. And the trend is there, right? So everybody knows that the carbon thing is something. And I looked at dozens and dozens of companies, went in there and didn't see anything like really like value driven, or they don't solve a really big problem. So a lot of marketplaces out there, but no one actually is capturing carbon or actually like reducing. And there were a couple of them, but it's still like going into each of those, and the whole trend is not going to win. Only specific people who've like Ringo is one example. Guys have been in the plastic industry and the packaging industry for 10 years. Know everything about that. Now they're reinventing the packaging. So taking every little like crappy plastic which is not recyclable and creating an alternative which is recyclable, and doing like a really mundane kind of thing, or a really practical thing, but that's how they actually avoid carbon getting to the atmosphere by reusing these good packages. And secondly, like now AI is a hot topic, quite sexy, but if you go into the companies, try to understand what they're doing. Everybody's like using OpenAI as an infrastructure and building on top of it, which is not a unique value on its own. Maybe some are good aggregators, can pull in tools together, like make a marketplace, but is that the next app store? Quite difficult. So you kind of want to see somebody maybe building the OpenAI itself, like an infrastructure which others can build on and use. But that's really early. I mean, I don't say that I understand right now what is the value in there. But in any new hot trend, I still have gone into it, tried to understand like tens of companies, and trying to understand who actually know about the sector as well, and not just like, I don't know, the founders who build a company just because they want to be entrepreneurs, but they don't like, they have a hammer and they're finding a lot of nails.
Yeah.
If I may,
of course.
In terms of losers, I think anybody who's not taking the ESG seriously now will be a loser in the future. I mean, no big funds, no corporates, no large investments will be able to invest into anything that's not ESG compliant. So the companies need to prepare for that, and anybody who's acting against it, or they're not going to fare well. So ecology, renewables, sustainability are the themes that are going to go with us for the next 10, 20, 30 years.
So yeah, maybe for Marko, yours, the slide that you had with the KPIs and with the metrics, there should be one more column with ESG and on the impact side.
Yeah, I think actually the mission and the course KPI is something that everybody has to adopt. And the course can be either it's emissions or it's some kind of other ESG related thing, like governance kind of thing you want to change, or a social aspect you want to change, equality or inclusiveness or anything like that. But I think the cause should be there as well. Should be come from inside. So it should be something you want to change as a company.
Yeah. So actually, a topic that I wanted to touch upon is actually the public money or the support coming from the governmental side to those sectors that I don't know whether they need to push or are actually just pushed because of the ESGs and the clean and the energy crisis that we're facing. So, and I want to use this opportunity that we have a Finn, Slovenia, Estonian. I hope to have a Polish one here as well, as they are really strong with the governmental investments into this sector. So what is your takeaway, guys? Is it that the more public money on the markets on a specific sector, the better, or should we actually put a cap on or leave this on a side when the markets are going better? So like just elaborate on your thoughts on the public money in VC capital or VC industries. Petri, what about you or Rock if you wanna jump in with that?
Let me start on that. Unfortunately, we see too many founders and companies who get hooked, who get addicted to public money. So they get from one grant to another grant to third grant. Money is easy. All you have to do is write a good proposal. These are not good business practices, and these companies are not good investments. So these kinds of companies, they become a lifestyle businesses, lifestyle of being sucked to being ready to get some grants for the next round.
Petri, what do you think about that? Yeah, go ahead.
In Finland, we have Business Finland, which is giving some grants, but mostly loans. But yeah, we have seen situations where basically the tail begins to wag the dog. Really, the government money directs the companies' expenses higher or doing stupid things. And yeah, there should be a cap on how much government money should be given. Then when we are talking certain in the industries, clean tech, etc., those ones are research intensive. And of course, that's a little bit different situation in certain industries. But for example, softwares, typically there should be a cap on available government money for those companies. It gives them more interest in developing the business than raising grants.
Yeah. One is the grant side, but the other one is when the governmental funding or public funding is put together with VCs or with private money. So we see this going on in Estonia quite a lot with sort of direct, but boost like private capital boosted with public capital. So Marko, what's your take on that? The grant side, but also the boosting private investments.
Yeah, when I addressed the co-investment side, or basically right now there's a new structure where when there's a lead investor, then they'll match up with the same terms. They don't dictate the terms, but they'll just like do up to half of the round in certain mandates. And I think it's the same with other countries as well. Many have this structure in place. I kind of have the view overall on the public money as really necessary. I'm not talking about maybe the grants, or maybe there is a dark hole there where you can drown into, but essentially all the venture capital funds, like especially the first, second funds, are subsidized, or the larger anchor investors are usually either governmental funds, fund of funds, European kind of central bank closed fund of funds. So a lot of the early stage money, even through funds, is still like mandate money that comes from like European mandates, local mandates. So I think the whole ecosystem wouldn't stand up on its own feet in the early days, just on the private money. So you need like a huge amount of unicorn exit founders who have like evergreen funds, like maybe Davet has in Estonia, in order to have a substantial amount of money in the market. So until that happens, I think it's really important for the fund of funds from the governmental side to be there, because this is how Superangel got started. Both of the funds have anchor investor is SmartCap, who's a Estonian fund of funds. Any other fund I know has kind of a similar anchor investor in place. So I think that's really important. And now when they are doing co-investments as well, validated still by the local expert investors, I think it's only good, actually. So
yeah, the grants and public money into the funds is, I think, a bit different thing in its essence. And I truly believe that myself that science-specific or science-oriented startups should be somehow, or the private money actually should be boosted or should be helped with public funds. So how about Slovenia? Now in Estonia, we have those just coming up, actually, the public funding backed up or packing up at the private ones. So
it always comes to solve a specific problem, right?
Yep.
So it used to be just get the early stage capital markets going. Now it's directed to deep tech, directed to green tech, and etc.
Yeah. What about Slovenia? Do you have those there as well? That public plus private?
Yeah, they were available this year, not, but they were available in previous years. Not very widely used, unfortunately. Part of the reason is because the conditions that were attached to the public part of the funding. So you could have they have matching funds from the state. However, the conditions was such that the founders and/or investors started to reject them. So I know a few cases where the public money was approved, but then the founders or private investors rejected because it gave too much rights to the state in terms of when can we exit, what are the conditions for the next rounds, etc., etc. So it was limiting in terms of founders, the companies getting more money in the coming rounds. This year, this is not available, and hopefully the whole terms will change in the future, or rather it will go to sort of privately managed funds and then matching, rather than some bureaucrat somewhere in the office saying, yeah, this is a good investment, we should match, and this is not a good one, because the bureaucrats, unfortunately, are not very good selectors of good companies usually.
Yep. Actually, so this was the governmental side that I wanted to touch upon, especially on the hard times or fluctuating times on the market that the public money could support. But as we're soon running out of time, and still the 4NGELS project itself and the program itself is to support and help the cross-border investments. And with cross-border, I don't mean that Estonian investors need to invest in US or to, I don't know, even to Portugal, but in the region, we're quite close, all of us in this region. So what are the cross-border takeaways or suggestions from you guys to angel investors, especially on those difficult times? Is there something that you can suggest on the cross-border level? Do you even suggest doing cross-border investments, or should we keep local, or what's your take on that, Petri? You with your extensive experience.
Yeah, it's. I would say it's cross-border. Definitely, as an angel investor, you need to network with the local guys. Definitely. What we learned was really the cultural differences are quite big, even if you go from Finland to Estonia, or Finland to Sweden, or Finland to Denmark. And you need to have the local guys who can tell, okay, who can help you to evaluate the team. Are they telling the truth? Are they capable? Are they basically present on that market, etc.? I would say doing your own self a cross-border investment is I would say a mistake, but doing that jointly with the local angels is definitely worthwhile. We have done now what we have done, about 25 investments outside Finland, but it's always with the local angels. It's always with the local guys with whom we we do the due diligence of the team due diligence with them. And really with our third fund, really one of the partners we have now was a co-investor we had in Sweden for 3 cases we have had in Sweden. And now he became a partner in our third fund.
Yep. Always go with the locals. Rock, what do you think?
Yeah.
Oh, I fully agree with what Petri was saying. I don't know. I mean, outside of Slovenia, it's really for me difficult to understand how teams are doing. Know the local specialities. It's difficult to judge the teams. Oh, I would also say the same thing that Petri says. Go with the local partner. Now the problem is how to find the local partner. That's why we need IBAN. That's why we need guys like you. So that I meet Petri, that I have a drink with him or two, and then we see how each other think and what are his thoughts about investing, and then I might consider investing with him, and he investing with me. So you need to have trust in your local angel, but definitely go with somebody who is locally there. This is the case with Slovenia. We have very few foreign investments because the large VCs don't have offices here, which means their investment managers are not here and then don't know the local scene. They don't know the local startups. So always have a local person present. And the same goes for startups. If they want to sell something in Germany, they need to have a local sales guy who's a native in German. So it is similar across the whole board. Us investing in startups, but also startups making business in foreign countries.
Same thoughts?
I would add to that on the operational admin side as well. Mm-hmm. If you're investing as an angel, you're the only one in some certain markets. A new SHA or investment agreement comes in. You don't know anybody local because the legal systems are different. The terms might be different as well. And if you're an angel investor trying to look through 100 pages of documents, don't want to hire your own lawyer because the lawyer costs more than your own ticket was in the company, then it comes really hard, especially when you have 10 plus investments already, like everywhere scattered. So, then you invest in Singapore, you need to wet ink stuff, then you need some assistant who actually prints the documents, scans them. Nobody has scanners anymore, whatnot. So all the admin stuff to basically make this more efficient, it's better to have a group of people, and then usually syndicate leads do the due diligence in each round as well. Funds do it as well when you're close to funds or anybody else in the local market. Then you can ask, like, was there any like red flags coming up with this new documents or whatnot? So obviously very network-driven business kind of, or just it helps in any way. I mean, just to know the people and do everything more efficiently, get better outcome.
Yep. So 2 minutes to end the game. So guys, last suggestions from your side, or last thoughts from your side. Where do you see the market going, and how do you suggest investors to be in this market situation at the moment? Whoever.
It was said before, these may be very good times for investments. The valuations have come down, the money is scarce, so the companies may be willing to do rounds that are more that are better for investors, and the economy will come back. So I think these are good times to invest, but spread out. So do more of the smaller tickets.
Petri, I think these were words from your brain.
Yeah. Yes. I can't really. There's no reason why not to invest. On top of the funds, I do also private investments. I have done this year 1 investment already, maybe doing 3-4 more on the outside the technology segment. And yeah, really, I say there is not that much big change really on the market. It's definitely worth to do investments continuously, and you need to spread out. You can't do the investments in 1 or 2 years. You need to be doing them over a number of years.
Mm-hmm. Yeah, I think just have the long-term perspective in mind as well. So as an angel investor, you're kind of like planting seeds to the future, which are maybe gonna spring up in the next 10 to 15 years. So really, it's really good if you like the industry, if you like to understand, like work with people in tech, be in the tech scene, and then buy yourself opportunities for the future, or basically potential outcomes to the future. You're not going to yield any like big gains really quickly. It's going to take a lot of time. Sometimes you get rather experience than profits and all of that. So you should like the game or like the industry, want to be part of it, and then buy a lot of opportunities to the future. And then in 10 years, you might be in a really interesting spot where you might be, your title might be a little bit different. So you're introduced as I don't know, the first investor in Bolt or something. So this only happens when you do the hard stuff right now, and invest consistently throughout the years and spread out as well as angel investor.
Yep.
And don't get out of the market. The startups still need us as investors. Startups need our support. Startup needs our money even more than in other times. So let's stay in the market and let's keep investing.
Yeah, I could. Well, that's really looking back on the 10, 15 years. Angel investors, this isn't business what needs to be learned. It's not like some miracles that happen overnight. You need to keep investing and fine-tuning your investment thesis. And then too often angels get out of the business because I don't get returns. I don't get any positive exits too early, just about when they were about to learn what the business is about.
Yeah, so all of your thoughts are really good to end this session this morning. Marko, thank you. Petri and Rock, thank you so much for joining us. And the next training session for 4Angels is going to be in the early days of May. I think it was the 3rd or 4th of May. Oh my God, I can't recall. So anyways, early days of May, we're going to speak about the legals and the taxation that might be a challenge for cross-border investing. And as you said, that this might become really a hassle when you do cross-border. Thank you very much, and thank you everybody for joining, and have a really lovely day.
Thank you. Bye-bye.
Thank you. Bye-bye.
Thank you. Bye.